Good morning. Welcome to Money Beat. I am Paul Vigna. U.S. stocks this morning, pretty tepid. You can see the Dow down about 42 points there. The NASDAQ and the S&P also not doing so well. The market this week, you can see it in the market. Traders, investors are kind of recalibrating their opinion when the Fed might begin hiking interest rates. That's kind of filtering through. You had weekly jobless claims this morning. You saw they rose to 315,000. Questions about how much of that was associated with the Labor Day weekend. Still, the number roughly around 300,000, a little more, a little less, give or take, week to week. You can take that. Traders and investors, like we talked about, they are trying to figure out exactly what the Fed is going to do, when they're going to do it. All revolves around interest rates, what that will mean for the markets, what that will mean for the economy. But our next guest says the Fed's got it all wrong on inflation. That has led to mistakes. It will lead to more mistakes. Peter Schiff is the CEO of Euro Pacific Capital. It joins us right now. Peter, good morning. How are you?
I'm well. How are you?
I'm doing okay. Look, September 11th, somber kind of day, right? Yeah. But let's talk about the Fed. This is what's floating through the markets right now. We have a meeting coming up. People are talking about interest rates. Are they focused on the right things with the Fed?
Well, they're not. Unfortunately, interest rates have been too low for too long. That is a big problem. But unfortunately, they're not going to be raised anytime soon. And ultimately, when interest rates do go up, it's not because the Fed wants them to go up, but because they have no choice. But I think the next thing the Fed is going to do is launch an even bigger round of QE than the one they're tapering off from, because the U.S. economy is not recovering. We are slipping back into recession. If the Fed doesn't know that yet, it will by the end of the year, and it's going to have to reverse policy. So this talk about a tightening is all talk.
So you don't think that the economy is in this kind of slow and steady mode that everyone really talks about? This seems a general opinion. You don't think that?
No, not at all.
Slipping back into recession?
Well, look, we're in worse shape now than we were when the Fed started this experiment in 2008, 2009. All the problems that the Fed caused that led to the financial crisis have been exacerbated by the monetary policy it's pursued post that crisis. We've just inflated a bigger bubble. The air is already coming back out. And I think the Fed knows this bubble is too big to pop, because the financial crisis that would ensue would make 2008 look like a Sunday school picnic. So they're getting ready to blow as much air into this bubble as they can. And so they're going to launch a new round of QE that I think will make the Europeans and the Japanese blush.
I have to ask, they have not intimated that at all. They've not talked about that at all. So you're saying that basically the economy is going to drive them to that. I know we had 140,000 jobs created, the last jobs report, which is well below what people thought. But not a terrible number. We've been around none of the numbers have been great to begin with.
No. And in fact, even when we were getting 200,000 jobs a month, they were part-time jobs. These were lousy jobs.
Right. Low-paying jobs, not great wages.
And if you remember, the GDP for the first half of the year, GDP growth was just 1%.
Right.
And all the weather anomalies are smoothed out because you've got the entire first half. So they were looking for 4% for the full year coming into the year. They got 1% in the first half. They're still looking for 3 to 4% in the second half. It's not going to come anywhere close. So we've been decelerating now for 3 consecutive years, because the best GDP growth we had was 2012. 2013 was down, 2014 sequentially down, and I think we're in recession by 2015.
Let me ask you a question on how this pertains to the markets. Even assuming you're right, and nobody cares. And I don't mean that in a bad way, Peter. I'm saying, you, other bears, guys are getting chased out of the market because the Fed is just keeping rates at low levels. And as far as the market is concerned, that's all they care about. Yeah. So say you're even right. What do you tell investors?
Well, look, I haven't been bearish on the stock market, even though I'm bearish on the U.S. economy.
Yeah.
Right? I've been bearish on the dollar. The dollar has rallied recently, but I think that's going to be short-lived. The problem is the Fed is going to keep on making one monetary mistake after another. They're going to destroy the value of money, which means nominal stock prices have to go up. Mm-hmm. But don't confuse that with a vibrant economy. And it's not because corporations are becoming more valuable fundamentally. It's just because money is losing value. And a lot of the earnings growth that people talk about is all because of share buybacks that are financed by cheap money. And a lot of the earnings are a function of low debt costs and the fact that since companies have low debt costs, they have more money to spend on the goods and services that other companies sell. But it's the Fed is entirely propping up this market. And so even though I can be bearish on the economy, I can still feel that the stock market's going to go up, but it's going up for the wrong reasons.
Right. It's a dangerous ride. Peter Schiff, we have to leave it right there. Thank you very much. Thanks for coming in.